It's time to tackle the financial sections of your business plan. Your launch and continued success will depend on how well you structure your financials. Let's begin with startup financing.
Once you've understood your operations and marketing, you'll need to figure out what it's going to cost you to get your business up and running.
Startup financials are an important element of your business plan. They will tell a potential investor or financial institution that you've put a lot of thought into how you will get to your launch. Every business requires some capital to get started.
At the core, startup costs are anything that you need to secure before you open your doors or make your first sale. This is in contrast with the costs that you'll incur while running your business. For instance, utilities and rent are operational costs.
Startup costs were a difficult thing for us. Being new business owners, we had no idea what to expect.
That I'd have enough money to complete all my renovations so that the stylists and all the new clients would be happy with their new space.
My concern with startup costs was being able to afford the necessary equipment to be competitive.
That I would have enough money for the huge amount of inventory that I had to have in the salon for stock and for resale.
It was also important that the machinery lasts and didn't break down.
That I'd have enough money for working capital.
And lastly, it was important that the machinery got up and running and we were able to make our money back on it.
Which is why I started renting chairs in the first place, so that I could make that up a little bit quicker. And in that end, it took about 6 months to do that.
I had a strong business model, and Futurepreneur saw that. They funded me, and with that seed money, I was able to launch my business.
And of course, the big thing, would we have enough? Would there be enough to cover all of those costs?
I received my initial funding from Futurepreneur Canada and also applied for a Manitoba Startup Loan. This allowed me to cover my startup costs and hit the ground running.
We knew, though, that Futurepreneur would be a great resource. They certainly helped us to see exactly where we could put our funding toward.
Our initial funding came from Futurepreneur. Having the support of Futurepreneur allowed us to leverage more funding from sources like BDC and RBC.
But that's what the business plan really helped us to do. It helped us to see how we were going to allocate all of those funds.
So the financing that I received for my business was my own owner's equity. Secondly, I got a loan through Canadian Youth Business Foundation, great repayment plan. And lastly, I was gifted money through my parents, which the bank actually called a love letter, so that I didn't have to pay any interest back on it.
And then, of course, ensuring that we had a rainy day fund for unforeseen costs. We needed to make sure we were fully prepared.
And the best part about Futurepreneur is that we are always a part of the young entrepreneur family.
Startup costs are costs you incur to start your business. These are fixed costs like equipment, like furniture for your restaurant. They could even be a storehouse of inventory that helps you get your business off the ground. Ongoing operational costs are operational costs related to the ongoing operations of your business. So for example, you're purchasing food to sell, or you might be paying for salaries for a staff or an employee. The best way to calculate your startup costs is to make a list. List off all those important expenses that you're going to incur to get your business off the ground. So these could be things like equipment, furniture, office supplies, maybe a laptop computer. All of these expenses are going to be needed to get your business moving forward.
Let's take a closer look at building your startup costs. For this, let's say our business is a new bakery. First, we've made a list of everything you need to start. Equipment, inventory for your first batch of baked goods, the first and last month's rent for your location, your business registration, your legal fees, and your licenses.
Next, let's put in our numbers. Add these numbers to get the total of your expenses.
Second, let's make a note of what capital you'll have available for those costs. Usually this comes in the form of owner's contributions, money that you already have that you'll be using, and loans, money that you've borrowed from lenders. Now let's put these numbers in. Add these numbers together to get your available capital. Next, let's take the total of the expenses and subtract it from the available capital. In this case, we're on the positive side. That's good. If your startup costs are more than the money you have raised, you'll either need to reduce your costs or find additional financing. If your startup costs are less than the money you have raised, then the remainder becomes working capital, which you can use for ongoing costs.
Startup costs can be a difficult thing for entrepreneurs to ascertain. You need to make sure that you have enough financing to cover these starting costs and your operating costs for the first year. I implore entrepreneurs to be careful not to bootstrap their businesses, because by the time they do need financing, they've maxed out their credit.
So tell me a little bit about Grow-Nuts.
The name came from just the concept of two brothers making donuts, and we just focus on quality in our products, whether it comes to when it comes to coffee and donuts.
Yeah, whenever we're putting forward our product, everything is made from scratch in-house. Our coffee is roasted in Canada. Just the quality of anything that's going across our counter is really important to us.
What are the top 3 things you were concerned about in regards to startup costs?
First off was equipment. Trying to get a sense of how much equipment you'll use, but also giving room for reasonable growth. Second would be allowing, if you're doing whatever space, renting office space, technical equipment, if you have a commercial kitchen, try and design your space and building it to accommodate, again, reasonable growth. For us, our kitchen is way too small for the amount of volume that we do now, but we didn't know that when we started up.
Anything that our customer gets their hands on or anything that they touch, we want to make sure that it's good quality, whether it be the chairs that we use, the cups that we use, the boxes that they take out, just everything that they haven't experienced with. We wanted to make sure that it was really, really good.
What were some of your financial considerations when hiring staff?
Right at the front, you want to overstaff just to, if you have a retail location or some sort of restaurant, just overstaffing to make sure that your first impression is really, really good. But just make sure you have a cushion going into that, because if you have 15 staff on your payroll and then you only need 7, you need to quickly make that decision. Otherwise, 2 or 3 payroll periods of overstaffing will knock you out.
What are some examples of unforeseen circumstances that you encountered, and how did you deal with it?
Having more customers than you're anticipating. If you plan to make 200 donuts a day, and you have 75 people lining up in the morning, you're going to run out of donuts in an hour.
I'd say that you have to understand how to make more product, because for us it seemed like an easy solution to just get a larger mixer and then make more donuts, but there will be a bottleneck somewhere. So for us it was almost a puzzle, because our fryer became a bottleneck and donuts started to proof too much or rise.
So you want to balance being able to ramp up your volume quickly, but then also dial it down and have a low staff, because if there's a minus 45 winter day, you're not going to have 80 people lining up at the front. Whereas if you have a festival on the street in front, you need to be able to make more. So scaling up and scaling down is really important. Don't buy a huge fryer to accommodate for a huge amount of people, where in a month from now you might have half or a quarter of those amount of people.
We're in an exciting spot right now where we're looking at year 2 growth coming out of year 1. Things have been really good. We've had ups and downs, made a lot of mistakes, and had a lot of really good decisions that have gotten us to where we are.
So where did you get the financing to start up your business?
We got our startup costs initially from kind of 3 sections. On the public side, we got from the bank, from BDC, and then from Futurepreneur. And then the other half of our financing was a private loan.
What important piece of advice would you give to a new entrepreneur about startup costs?
I think money would probably be the most important thing, but just don't underestimate the actual costs of it. Don't be afraid to get used equipment when it's necessary, but spend the money also when you need it.
It's more expensive than you think.
Yeah.
So always estimate and plan for like 50%, 60% cost overrun than what you initially thought.
It'll happen.
It just happens. And you can't open a cafe or you can't open some like commercial kitchen unless it's existing and you're moving into a space that already has something in place for under 200 grand.
Great advice. Thank you. And proof of a quality homemade product is in the pudding.
Acquiring startup financing will usually involve securing a loan from an organization like Futurepreneur or a financial institution. There are many places that you can get a loan from. The amount that you can secure and the interest terms that you'll have to pay will depend upon your credit score. Your credit score is a history of your ability to pay off debts, such as a cell phone, credit cards, and a credit line, as well as how much credit you currently utilize. Keeping your credit score healthy is a good indication to the bank that you are demonstrating good behavior in servicing your debts. Your credit score is basically a judgment about your financial health at a specific point in time. So this can change from day to day. You could pull your credit on a Monday, pull your credit on a Friday, and the score can actually change slightly. It's the risk that you represent to lenders compared to other consumers. So the bank looks at your credit score and tries to decide whether they should give money to you. So the higher your score, the lower your risk. So you'd be looking at a beacon of anything about 700 or more in order to get financing. The amounts owed, what you actually owe on your credit cards, your line of credits, your payment history. Do you pay things on time? Are you late? Do you pay in full? Do you pay just a portion? The length of your credit history. How long have you had those credit cards? The types of credit you have. There are cell phones, there's credit cards, lines of credit, RRSP loans, and any new credit that you've tried to acquire. So if you go out and get a Sears card or an Eaton's card at the same time, that's actually going to drive your credit down. You should wait about 30 days when you're applying for new credit if you're going to be looking at obtaining a business loan for your business. There are two providers in Canada, TransUnion and Equifax. The easiest way is to go online, pay a small fee, around $23, and they will send you your credit score within about 5 minutes. Always make your payments on time. If you can't make your payments, contact your lenders. They will usually work something out with you. Never go over your credit limit. Always remember that there's going to be interest that's going to be charged, and factor that in when you're making at least the minimum payment every month. If you apply for too much credit within a certain period of time, you will get flagged and your credit score actually drops. Don't overuse the amount of credit that you're utilizing. Try to keep credit at about 35%, especially if you're going for a business loan. If your credit's maxed out, lenders will not give you that money because they're afraid that there could be a chance of claiming bankruptcy or not having the proper cash flow. Also, if you're applying for credit, don't do it all within a short period of time. That can actually decrease your credit score when you're shopping around for credit. At the end of the day, make sure that you can afford to pay back any money that you borrow for your business. One little tip is I tell business owners to set up an automatic withdrawal to pay off all of their operational costs on a monthly basis. That way, you don't forget to pay your bills.
Hiring an accountant is extremely valuable to your business. They're going to make sure that you collect all your receipts and get things organized into an accounting platform. They're also going to make sure that you write off all the expenses and deductions that you have fairly coming your way. So in the end, they're going to likely save you a lot of money. doing this while your business is running can often be a lot less expensive than if you attempt to do it later and play what we call catch up. So I'm going to talk a little bit about the difference between filing your personal, business, and corporate tax. Personal taxes are filed on an annual basis and are the accumulation of the T-slips and deductions from throughout the year. Your personal return is due on April 30th of every year. Business taxes are filed with your personal return, which accumulate all of your revenues expenses incurred by your business throughout the year. Net income from these businesses is added to your personal income. Net losses are deducted from your personal income. If you are filing a business return, your filing deadline is extended to June 15th for your personal return, but you must pay your balance of taxes by April 30th to avoid interest-bearing charges by CRA on the outstanding balance. So corporate taxes are filed on behalf of a corporation and can have varying year ends based on your selection. A corporation is a separate legal entity, and as such, money given to or taken away from the corporation needs to be tracked effectively. As an owner, you can choose to pay yourself as an employee and take a T4 or employment income, or you can choose to pay yourself a dividend and take a T5, which is investment income. You have 6 months after your selected year end to file your corporate return. Get yourself an accountant. Sit down with them and discuss your business. Get them to understand your business, get them to learn about your business. They're going to be able to identify expenses that you may not have thought that you could write off before. I will say in the end, find an accountant that works with you and is able to go after those deductions that you want to deduct while respecting CRA. It's always a great idea to be very fair when dealing with CRA to prevent any issues from happening if you are reviewed or audited on your expenses.
Make sure you take everything that you've learned in this video and put those numbers into our online cash flow template. This will help you determine your startup costs. Thank you to the Province of Manitoba and Futurepreneur Canada for making this video series possible. Please check out the rest of our series online. Until next time, goodbye.